Two people can earn the same income and end up in completely different financial lives. One builds savings, investments, and choices. The other drives a newer car, lives in a bigger home, and looks successful, but one unexpected bill can push everything onto a credit card. The difference is often not income. It is 12 normal-looking financial traps that quietly destroy the gap between what you earn and what you keep. In the United States, household debt reached approximately $18.8 trillion in the first quarter of 2026. Credit card balances stood near $1.25 trillion, while auto loan balances approached $1.69 trillion. And according to the Federal Reserve, only 63% of adults said they could cover a $400 emergency using cash or its equivalent. That means more than one-third would need to borrow, sell something, carry the balance, or find another solution. This video will explain all 12 financial traps and show you how to recognize them. Stay until the end, because we will reveal the middle-class trap filter, a simple 4-question tool you can use before buying a car, upgrading your home, adding another subscription, or committing to almost any major expense. The first trap is lifestyle creep. Imagine receiving a $500 monthly raise. It feels like progress, but then the apartment upgrade costs $250 more. Eating out increases by $120. A better phone adds $60. New subscriptions add another $40. Income increased by $500, but the lifestyle increased by $470. The raise did not create wealth. It created a more expensive version of the same financial stress. Lifestyle creep works because improvements quickly become necessities. What once felt luxurious soon feels normal, and normal spending becomes difficult to reverse. The second trap is the car payment treadmill. A fully paid-off car may not be exciting, but it gives your paycheck room to breathe. Then a promotion arrives, and a $600 monthly car payment suddenly feels affordable. But the payment is only the beginning. Insurance rises. Fuel may cost more. Registration, tires, servicing, cleaning, and repairs follow. A car advertised at $600 a month can quietly consume $850 or even $1,000 of monthly cash flow. The driver looks as though they have moved forward, but financially, they are running on a treadmill, spending more energy while remaining in the same position. The third trap is the minimum payment illusion. Suppose someone carries a $5,000 credit card balance at 24% interest. That balance can generate approximately $100 in interest during the first month alone. If the person pays only $125, barely $25 reduces the original balance at the beginning. The account is technically being paid, but the debt is barely moving. Minimum payments make a dangerous balance feel manageable because the immediate monthly demand looks small. But small payments can keep old purchases alive for years. The fourth trap is becoming house poor. The bank approves the mortgage, so the buyer assumes the house must be affordable. But mortgage approval answers a different question. It tells you what a lender may allow, not what will leave you financially secure. A $2,200 mortgage can become a $2,900 housing reality after insurance, property taxes, utilities, maintenance, repairs, furniture, and upgrades. The family owns a home, but the home consumes every raise, every bonus, and every spare dollar. They may have equity on paper, but no breathing room in real life. The fifth trap is buying the wrong kind of life insurance. Whole life insurance is not automatically bad. It provides lifelong coverage and can build cash value. It may serve certain permanent coverage, estate planning, or business needs. The trap begins when an expensive and complicated policy is sold to an ordinary household as its main path to wealth. A family may commit hundreds of dollars every month to a product they barely understand while carrying credit card debt, lacking emergency savings, or failing to use simpler investment accounts. Insurance should protect a financial plan. It should not become a confusing financial plan by itself. The sixth trap is paying for convenience without measuring it. A meal costs $12. Then come the service fee, delivery fee, small order fee, and tip. The $12 meal becomes $27. A rideshare replaces a short walk. A premium delivery membership encourages more orders. A daily $20 convenience habit across 22 workdays becomes $440 every month. Convenience is not the enemy. Unconscious convenience is. The payment is invisible, instant, and emotionally painless, which makes repeating it extremely easy. Now pause and notice the pattern. None of these traps looks dramatic. That is exactly why they work. The seventh trap is keeping up appearances. A friend buys a new car. A coworker upgrades their phone. Social media shows vacations, weddings, kitchens, watches, designer clothes, and perfect homes, but rarely shows the loan balances behind them. People begin purchasing evidence of success before building the foundation of success. They finance the image and then privately carry the stress. They look wealthy in public while their future income is already promised to lenders. The eighth trap is having no emergency fund. The car breaks down. The refrigerator fails. Working hours are reduced. A medical expense appears. Without savings, an $800 problem becomes a credit card balance. That balance creates interest. The interest reduces next month's breathing room. Then another emergency may arrive before the first one has been paid off. An emergency fund does not produce excitement. It creates distance between a problem and debt. The ninth trap is retail therapy. Stress creates discomfort. Buying something creates a short burst of relief. Then the bill arrives and creates even more stress. That is the cycle. It may be an $80 outfit after a difficult week, a $120 gadget after an argument, or a late-night online order because life feels out of control. The purchase is not solving the real problem. It is changing the emotion for a few minutes and transferring the financial pain into the future. The 10th trap is delaying retirement saving. Many people say, I will start when I earn more. But waiting costs more than the contributions you fail to make. It also removes years of potential compounding. For example, investing $200 every month from age 25 until age 65, assuming a hypothetical 7% annual return, could grow to approximately $525,000. Starting at age 35 under the same assumptions could produce approximately $244,000. Returns are never guaranteed, but the lesson is clear. Starting earlier gives your money more time to potentially compound. Investor. Gov similarly emphasizes that beginning later generally requires investing more to reach the same long-term goal. The 11th trap is the brand loyalty tax. People remain with the same insurer, bank, phone company, internet provider, grocery brand, or subscription because comparing alternatives feels annoying. Introductory prices end. Fees rise. Better options appear. But the customer remains on autopilot. The trap is not liking a particular brand. The trap is allowing loyalty to replace comparison. A $25 monthly difference across 4 recurring bills equals $1,200 every year. The 12th trap is the side hustle trap. A side hustle can be powerful when it pays off debt, develops a valuable skill, funds investing, or creates a future business. But it becomes a trap when someone works every evening simply to support a lifestyle their main income cannot afford. They earn an additional $700, then increase their monthly spending by $600. Now they have less time, more exhaustion, and almost no additional wealth. The extra income did not create freedom. It made an unsustainable lifestyle temporarily possible. So what is happening beneath all 12 traps? First, there is normalization. When spending happens repeatedly, it stops feeling optional. Second, there is present bias. The pleasure arrives immediately, while the financial consequences feel distant. Third, there is social proof. When everyone around you finances cars, homes, phones, holidays, and appearances, the behavior begins to look normal and safe. Fourth, there is payment blindness. People focus on the monthly amount while ignoring the total cost, the lost flexibility, and the years of future income being committed. This is where the middle-class trap filter becomes useful. Before taking on a new expense, ask for questions. Does this decision create a recurring payment? What is the full yearly cost, including fees, interest, maintenance, insurance, and possible upgrades? How much will this reduce the monthly gap between what I earn and what I keep? And if my income stopped for 90 days, would I still feel comfortable carrying this decision? Those 4 questions slow down the emotional part of the purchase and force the financial reality into view. Then protect the gap. When your income rises, automatically direct part of the increase toward emergency savings, high-interest debt, or investing before your lifestyle can absorb it. Build a starter emergency fund before chasing appearances. Review your recurring bills at least once every year. Make credit card payments that attack the principal rather than merely keeping the account alive. And give side hustle income one specific mission instead of allowing it to disappear into random spending. Middle-class people do not remain financially stuck because they are lazy or unintelligent. Many people are working extremely hard within a pattern of seemingly normal decisions that continually undermine their progress. A bigger paycheck cannot build wealth if every raise creates another obligation. A side hustle cannot create freedom if it only funds a more expensive lifestyle. And investing cannot protect your future if debt, convenience, and appearances consume the money first. Financial progress begins when you stop asking, "Can I make the monthly payment?" and start asking, "What will this decision do to my future?" Continue with the Money Trap series because it exposes the hidden financial decisions that drain income, delay investing, and stop ordinary people from building wealth. Learn how to protect your paycheck, avoid common financial mistakes, make smarter money decisions, and build a stronger path toward long-term wealth and financial freedom, one trap at a time.